Hi, folks. I'm coming to you in the middle of the day today because it's a beautiful fall day in the central part of the United States, and I'm going to try to get through a number of things, uh, projects before the cold weather comes, and so I don't know if I'll be available this afternoon. So there's a couple of things on my mind that I wanted to talk about, and one of those is after the news on Friday from Humble. Humble is today, as you probably all know, who found me. Humble is up on strong volume. At the moment, it's up about 10%. It's been up a bit higher during the day. We'll have to see if this holds. I never know. I don't have a crystal ball. But one of the things that I was doing today, and then I thought, I wanted to share this, is looking at some of the basics of investing. And one of the things, with all the coverage of some of the specific stocks we've talked about, Humble, InMode, the TQQ, the UPRO, and some of the others, that sometimes we kind of miss the big picture. And so as we are now in November, I want to discuss just some of the basic concepts of investing for you to kind of recalibrate in your own mind and not be so fixed on one stock over another. Excuse me. So let's start with one of the basics. And one of the things that we've talked about that I would say is that it is so much easier to make money in the market these days because of the free tools, and one of the best ones is Yahoo Finance. So we start off with SPY. That's the benchmark that you want to go by. You want to beat the benchmark because you can go out and buy the S&P 500. And there it is. So what we want to do is hit full screen, and we will see that for the year to date, that's the chart for the S&P. Pretty nice chart. And if we go 1 year, about the same. Since we're late in the year here, it's not much different. But let's add some things here. Whoops, that's the wrong one. Let's add, first of all, some of the things that I've said one would want to buy. And with when the economy is on an upward trend, and it has been for a while, I think it'll continue somewhat more. So if we look at the leveraged indexes, and remember these can go down 3 times faster just as they go up 3 times faster. But let's put the UPRO, which is 3 times the S&P 500. Let's make that a lighter green. So right away you can see that if you would put your money into the UPRO for this year, instead of being up 25%, which is a very good year for the S&P 500, you would have been up 91.5%, 91.6. Now if we did 3 times the NASDAQ, which is again the TQQQ, we would see that for this year, so far, and this is one of the rare years, by the way, when the S&P leveraged is over the NASDAQ leverage. But the TQQ is now far behind, playing catch up here as we get toward the end of the year, at up 87%. Now that's just for the year, folks. As we go along here, what I want you to be understanding is that you want to do this periodically, and you want to add in the stocks that you own, and if someone is giving you if you have a self-directed IRA, or if you're in a company that has a 401k, you might look into, let's say it's on Schwab or one of the other online brokers, you can have multiple accounts. So you could have a trading account, let's say at Schwab, or you could set up a retirement account. So if you have a retirement account, if you got an accountant, talk to your accountant about this, but you could perhaps transfer the funds that you have already accrued in your company retirement account to a Schwab retirement account. As long as you don't take possession, you're not going to get taxed on that, and both are retirement accounts. But the point of it is you ought to go through what are you invested in your company retirement account. That's one of the things I would have you do, and you can do that on Yahoo Finance here. And put in the comparison chart just as I've been doing and see how are the things that you're invested in, how are they doing compared to, let's say, the blue line, the S&P 500. Hopefully they are doing better, but so many times they're doing worse. And that's why I say one of the things you might want to learn here is trying to get a hold of your own money, your own retirement, and not be going with the limited offerings that sometimes you get when you're working at some company and they say you can only invest in the things that we say you can invest in. You want to be able to invest in, items that are going to give you the biggest bang for the buck when you retire. But either way, setting retirement accounts aside, even if you're a 20-year-old listening to this, you want to be doing this comparison. So this is year to date, and it can change over a period of time. With the S&P there in blue, with the TQQ in gold, and with the UPRO, which is 3 times the S&P, how would they have done over the last 2 years? Well, here we see that the TQQ over a longer period of time just kicks butt over the S&P and over the leverage version of the S&P. And if we go out 5 years, it's going to be even more pronounced. So this is why I like to use a 5-year chart ultimately when I'm comparing things. But let's go back to the year to date, and then let's just throw in some of the other things, specific stocks that we've talked about. One of them is DIG, which is a 2 times leveraged version of oil and natural gas. So let's make that a purple. And here we can see that for this year, for 2021, DIG has been kicking butt. And in fact, it was right at a year ago in November of 2020 when I thought, now that we're going to be having a vaccine, we're going to be reopening the world economy, that this is the time to buy a leverage version, to buy oil and gas and to buy a leverage version. So I was putting money into DIG, and we're up 139%. Now, there have been other times, and this is part of what I'm not just talking here, I want to pay attention. There are other periods of time that DIG was not good. Oil and gas was not a good investment over the recent past. It was, in my estimation, going to change because we were going to reopen the world economy. And we still have a long way to go on that. As you know, a lot of people haven't still flown so much. But this is where DIG has done well over the year to date. The full year, it's been up 280, I'm going to say 4%, 284%. Compare that to the S&P down there, which again is pretty good, 33% in a year's time. That's fantastic. But it's not 284%. So this is why number one, when I say money in politics, it's to put into context the environment into which we are investing, because politics and news always plays a part. You want to be aware of not just what the quarterly earnings are for something, but what's happening in the world and when has the game changed on certain industries. And this is why I thought, well, as we reopen the world, the game has changed over the oil and gas. Now, if we look back over the last 5 years by comparison, look at how badly oil and gas would have been. Over the last 5 years, it's been down 53.8%, 54%, let's call it. grossly underperforming the S&P 500, which is up over 5 years 116%. So this is a perfect example, which is why I wanted to walk you through this, where you want to pay attention to what's going on, because it's about the timing of what's going on when you make your investments. Now, speaking of timing, a lot of you FUDs out there about Humble are complaining when, again, you're not thinking in terms of timing. Humble's a startup. You're not giving it time to start up. You're trying to say it should have been producing all along. No, now as we get into 2022 is when Humble should be growing and producing, and that's what we're going to be looking for. But let me go on, because I'm really trying to here in this video give you the big picture. So we see, let's go back to our year to date, and that's how, if we're paying attention, we can get in. And am I going to hold oil and gas indefinitely? No, I'm not. I would say that a long-term hold would be the gold, which is the TQQ, 3 Qs, that's the 3 times the NASDAQ, and the green, which is the UPRO. And again, you're diversified on those holdings. You're not going to be exposed to the risks that come when you own one stock. Because when you own one stock, when you own, I should say, one company, when you're buying these indexes, you're diversified. When you buy into the stock of one company, then you have, again, what I call the one company risk, that any bad news can come out about that one company. It can be the Justice Department launches some suit, or something in Europe, the European Union says that company XYZ owes them back taxes, or the CEO, who is a visionary, dies, anything. You get the point. But when you are buying these indexes, the green and the gold, those are the leverage versions of the S&P and the NASDAQ. When you're buying those, you have in the green line, which is 3 times the S&P 500, you got 500 different companies. And the gold line, you got 100 companies. That's the NASDAQ 100. Now, I've talked about some of the other companies, and the point I'm about to make here, folks, is I think the leverage indexes should be a core holding, unless we see, because they're going to go down 3 times faster, unless you see that the world is changing, and changing in a bad way against a good investment environment. So if we get some bad tax policy or something else that they're doing, really heavy regulatory burdens, something that is going to kill the investing environment, then that would be a time to back out of those leveraged indexes and go back into cash, or at the very least sell some of your position. I recently, on the TQQ, sold some at 137. I didn't sell them all. After that, it actually for a while went down to 115, but yet today, the TQQ is up to about 170. So obviously, I lost some of the money that I sold at 137. But this is the way where you can kind of protect yourself. I built up some cash just in case. But on the other hand, I didn't get all the way out of the TQQ, so I am still participating on the upside. But I wanted to review where we are relative to some of the other things that we have suggested you buy. And one of the other things I've suggested you buy, as most of you now know, is InMode, INMD. And this is a company, again, I would say to hold on to for, I would say, the next, I would say 5 years or so. You know, you can review it as you go along. But this is year to date. And year to date, InMode is up 298%, which is fantastic, obviously. And if we go to a full year, it's up 351%. And if we go 2 years, 361%. Now, as you also see here, the gold line over 2 years, TQQ, and if you missed, see, this is where if you had missed in mode and you didn't know about it, because I didn't tell you about it 2 years ago because I wasn't on the air, but the TQQ would have also given you almost exactly the same return over a 2-year period. Now, we can't do 5 years because InMode isn't a 5-year-old company. It's came out in August of 19, so it's only, this is about the entirety of its living, of its history, I should say. So there you go. You can see that the UPRO over 2 years up 138%. What I suggest here, and I'm going to do a little bit more, but what I'm suggesting here is you want to have some of these leveraged index along with some real growth companies, and that's where you can trample and drive into the dirt the returns by the so-called professionals. You're going to kick the professional money managers' butts, and you're going to do it with these leveraged indexes and picking some great companies or at the right time. So again, notice how DIG was a good play for 1 year, but it's not been that good over the longer period of time. Let me momentarily take DIG out of there because that's a 1 year performance. And so that's one of the ones that we have been looking at over the period of time. Now, the other ones that we've been talking about is TTD, and that's Trade Desk. So that's TTD, as in Tom David. And let's try to make it where we have maybe a dark blue. And again, now this is a 2-year chart, and you can see how it is also, as an individual company, up 350-something%. If we go to year to date, it's not been that good year to date, although it's up about 23% today. It's just had some good earnings, and I do, despite what it's done this year, TTD, it is a good company. If I go to all 1 year, let's go to 2 years again. There we are. So over 2 years, up 250%. So I still think, and this just did a 10-for-1 split not too long ago, which is when I went back in. It had been at $630. At one point, it had been $900 a share. Let me see if I can. Yeah, you can see back in December 14, last December 14, it was at, it says $95, but remember that's a 10. It was at $950 based pre-split price. So my point is, folks, without going on and on and on, that number one, you have the tools here with Yahoo Finance to compare what your stocks are doing, and you should do this periodically. And if someone tells you to buy something, then compare this. And especially if we go out to a 5-year chart, now you can see, look at what TTD did, up $3,381, which means if you had invested in TTD 5 years ago, if you'd have put $1,000 in, it would be like $30,000 now, $33,000, almost $34,000. So this is, on the other hand, where things can go wrong with one company, things can go amazingly right. And this is why you want to have a combination where you have both the indexes and you go out and you try to selectively put money into some superstars. But don't, and this is a common problem, don't be putting all your money into one stock you think is going to be a superstar. I don't care if it's Humble, if it's TTD, if it's Amazon, Tesla, whatever. You want to have some diversification, because if for no other reason, there are going to be more than one superstar out there. And so we have as we go back to the chart, we have the TTD in the dark blue, but we also have in mode in red, which is up 1,720%. And we have the TQQ, which is just under that. So, folks, you want to have some real growth and some diversification, and there you go. And this is the thing that you should be doing on, maybe once a month. Go online and search for terms like fast-growing stocks, or look at the stocks and the fastest-growing mutual funds, and look into what they have, what's in their holdings, and Yahoo Finance will tell you what's in their holdings, and you can then do some research on that. So the chart on Yahoo is a great way for you to be finding some of the winners. And then lastly, again, if I go back just for a moment here to year to date, just because if you looked up just on the year to date and said, what's going on with these stocks, and you said, well, TTD is not a very good stock. It's only up 10% this year, below the S&P 500. In 1 year, that's true. But the reason there is I think it just kind of got ahead of itself. But it is a great stock. It is something I think you would want to have in your portfolio. And, let me throw in one more company here that we've talked about, which I think is going to have a good 2022, and that's Fubo. It's a gambling app. This is a way to take part in some of the gaming. And they're supposed to be coming out with their ability to go gambling online. It has not yet really taken off. If we go 1 year, it's had a decent 1 year, up about 120%, in line with both the leverage version of the NASDAQ and with the UPRO in the same ballpark. And you can see that's in mode way up there in the red. But I think it's going to have a pretty good year coming up in 2022. So that's another one I would be looking at. Let's go to year to date, and I'm going to throw in one last one. In fact, let me take out in mode because it's distorting it's hard to see what some of the other ones do. I'm going to take that out. The other one, which is Zynex, ZYXI, and it just came out with tremendous third quarter earnings, and they're going to be growing. Let's see if we can go maybe with kind of a salmon color here or something. So they've been not yet growing very well, and if we go to a year, you can see they're down. But I think that 2022 is going to be a year for Zynex to be coming back and performing as they did in the last 3 quarters, where they beat expectations. I believe I'm going from memory here, but I believe that's right. And they just came out with the third quarter recently and just had dynamite return, because again, they are going to have over 500 salespeople on their sales force by the end of 2022, according to their CEO. And the salespeople who have been hired in the relatively recent past are continuing to build their sales markets and sales per employee. So with that, 23 minutes, that's enough. But this is important stuff, folks, what we talked about here. I wanted to, as I focus on Humble so often, and we just got more news, as you know, on Friday about their application. So 2022 certainly is something where I think Humble could be their breakout year. Could be. We'll have to see. We got to go by their performance now. But where a lot of the critics of Humble have been whining throughout the year, they've been wrong, because they've been whining before Humble had a chance to build its business lines. Now we're going to see what Humble can do. And it is, as we know, a dynamic company added with the DAO blocks. And that's, another reason just to show, again, how dynamic Humble can be. Again, follow me on Twitter. I did tweet a bit today. I may get back to you this afternoon with another video. I don't know. Kind of depends what I can do here over the rest of the day, but it's going to be something like 63 degrees here or even more, close to 70, I think. And I got to get a little painting done, and you can't do some of the stuff once it drops below 50 degrees overnight. So I want to get this stuff done. Anyway, that's it for now, folks. Do pay attention to what I said. This is an important video here, and share it with your friends who want to get into the market, because this is really the kind of thing that they're not going to hear, I don't think, hardly anywhere else, but it's all good lessons. I wish someone would have been telling me about this when I was starting out. But for now, I'll say goodbye, and hopefully I'll see you. If not this afternoon, I'll see you tomorrow. Take care.